Oh yeah, that battery can last up to 24 hours even with the always-on display turned on. It's pretty cool.
Welcome. In our session today, we will undertake a detailed examination of cost volume profit analysis, frequently abbreviated as CVP. This is a genuinely fundamental tool in managerial accounting and strategic business planning. It provides a powerful lens through which we can understand and predict how changes in sales volume, costs, and prices will ultimately affect a firm's profitability.
Our discussion is structured logically into 6 key sections. We will begin with the foundational principles of CVP analysis, then move to the critical concept of the contribution margin. After that, we will apply these ideas to calculate the break-even point and plan for target income. Finally, we'll examine more complex applications, including companies with multiple products and the use of CVP as the dynamic tool for scenario analysis.
So, let's begin. With any analytical model, it is imperative that we first establish a firm understanding of its core concepts and, just as importantly, the assumptions upon which it is built. This first section will serve as the theoretical bedrock for all the calculations that follow.
So what is CVP analysis, precisely? At its core, it is a model that illuminates the interrelationships between several key variables: the volume or level of activity, the selling prices of products, the variable cost per unit, and the total fixed costs. By understanding these relationships, management can make more informed decisions about, well, almost everything that affects the bottom line.
Now, for the CVP model to provide clear, actionable insights, it must operate under a set of simplifying assumptions. First, we assume that the behavior of both total revenue and total costs is linear, meaning they appear as straight lines on a graph within a relevant range of activity. Second, we must be able to neatly classify all costs as either variable or fixed. Third, we assume that changes in the level of activity are the sole drivers of cost changes. And finally, for our basic calculations, we assume that all units produced are sold and that the sales mix in a multi-product company remains constant. These assumptions are what make the model workable.
With that foundational framework in place, we now turn to the concept that is truly central to all CVP calculations, the contribution margin. You can think of this as the primary engine of profitability within the entire CVP model.
To isolate the contribution margin, we use a specific format for the income statement, often called, appropriately, the CVP income statement. Now, notice how this differs from a traditional statement. Here, we organize costs by their behavior. We take sales and subtract all variable costs to arrive at the contribution margin. This figure represents the amount of revenue that is available to, first, cover all fixed costs. Whatever remains after that is the company's operating income.
To make these concepts tangible, we will employ a consistent case study throughout our discussion. Let's imagine a company with the following financial structure. It sells a single product for $500 per unit. The variable costs associated with each unit are $300, and its total fixed costs are $200,000.
Using our case data, the calculation for the contribution margin per unit is quite straightforward. We simply take the unit selling price of $500 and subtract the unit variable cost of $300. This leaves us with a contribution margin of $200 per unit. The interpretation here is critical. For every single unit this company sells, it generates $200 to put towards covering its $200,000 in fixed costs.
We can also express this concept as a ratio, which is an extremely useful metric. The contribution margin ratio is calculated by dividing the contribution margin per unit by the unit selling price. In our case, that's $200 divided by $500, which yields a ratio of 40%. This tells management that for every single dollar of sales revenue generated, 40 cents is available to contribute to fixed costs and subsequently to profit. Now that we have a firm grasp of the contribution margin, we can deploy it to answer one of the most fundamental questions in business. What is the company's break-even point? This is a level of sales at which total revenue exactly equals total costs, resulting in zero profit and zero loss.
There are 2 primary techniques for this calculation. While the mathematical equation is comprehensive, the contribution margin technique is arguably more intuitive for managerial analysis. The logic is simple. We have a total amount of fixed costs to cover, and we know how much each unit contributes to covering that amount. Therefore, the formula is simply our total fixed costs divided by the contribution margin per unit.
Let's apply this to our case study. To find the break-even point in units, we take our $200,000 in fixed costs and divide it by our $200 contribution margin per unit. The result is 1,000 units.
To find the break-even point in sales dollars, we take the same $200,000 in fixed costs and divide it by our 40% contribution margin ratio. This gives us a result of $500,000. And notice, these two results are perfectly consistent. 1,000 units sold at $500 each is indeed $500,000 in sales.
Of course, the goal of any enterprise is not merely to break even, but to generate a profit. This is where CVP analysis evolves from a tool of discovery to a powerful tool for planning. We can use it to determine the exact level of sales needed to achieve a specific profit objective.
The formula to achieve this is a logical extension of our break-even calculation. To determine the required sales, we must now generate enough contribution margin to cover not only our fixed costs, but also our desired target operating income. Therefore, the first step is to sum those two figures together. Then we simply divide that total by our contribution margin per unit. Let's apply this. Suppose our company has set a target operating income of $100,000. We first add that target to the $200,000 in fixed costs, giving us a total of $300,000 that must be covered by the contribution margin. We then divide that $300,000 figure by our $200 contribution margin per unit. The result is clear. The company must sell 1,500 units to achieve its profit goal.
A closely related and very important concept is the margin of safety. This metric quantifies risk. It is the excess of budgeted or actual sales revenue over the break-even sales revenue. Essentially, it tells management how much sales can decline before the company begins to operate at a loss. In our example, if the company expects to sell 1,500 units, its margin of safety is 500 units, the difference between the expected sales and the break-even point of 1,000 units.
Thus far, our analysis has been based on a single product company. However, the vast majority of companies sell multiple products. We will now address this added layer of complexity and see how CVP analysis can be adapted for a multi-product environment.
The key concept we must introduce is the sales mix. This is the relative proportion in which a company's products are sold. The sales mix is critically important because different products rarely have the same contribution margin. A shift in the mix from high-margin products to low-margin products can cause a significant decline in total profits, even if total sales units remain constant.
To perform a break-even analysis for a multi-product company, we must calculate a weighted average unit contribution margin. Let's consider this two-product example. Product A has a $100 contribution margin and accounts for 60% of sales. Its weighted contribution is thus $60. Product B has a much higher $250 contribution margin and makes up the other 40% of sales, giving it a weighted contribution of $100. By summing the individual weighted values, the $60 from product A and the $100 from product B, we arrive at a weighted average unit contribution margin of $160. We can think of this as the contribution margin for a composite unit that reflects our sales mix. This $160 figure can now be used in our standard break-even formula. We would divide total fixed costs by $160 to determine the total number of composite units needed to break even. Finally, let us examine the true strategic utility of CVP analysis. It is not merely a static calculation performed once a year. Rather, it is a dynamic tool for conducting sensitivity analysis, or what is often called what-if analysis, which is essential in a constantly changing business environment. This is where the model truly demonstrates its value. Let's return to our original single product case with a break-even point of 1,000 units. Now suppose management is considering a 10% price discount to stimulate demand. The price would fall to $450. This in turn reduces the contribution margin per unit to $150. When we recalculate the break-even point using this new CM, dividing $200,000 by $150, we find the new break-even point is approximately 1,334 units. That is an increase of more than 33%. This scenario analysis brilliantly illustrates CVP's power as a forward-looking instrument for strategic decision-making. It allows management to quantify the financial implications of their decisions before those decisions are made. The analysis transforms a qualitative question, should we offer a discount, into a quantitative one. Can this discount increase sales volume by at least 334 units? Ultimately, the CVP framework is not just about finding the answers, it's about empowering managers to ask the right, critical questions.